In our previous video, we looked at profitability and learned how to calculate the cost of goods sold, the cost of goods sold percentage. We looked at gross profit and gross margin, and we looked at the income statement and where we get this information. So we looked essentially at the income statement as listed on the left. Now, it's important to recognize that in accounting, some words are used interchangeably. So when we talk about net profit, you may also see the term, or instead, you might see the term net income. So the term net income and the term net profit are the same thing. So that means that when we look at our income statement, it may be worded slightly different than what you see on the left. So instead, you might see what's on the right. So you might see sales or revenue minus operating expenses, that's the overhead, minus the cost of sales or cost of goods sold, and that gives you operating income. So operating income and operating profit are the same thing. They are also called earnings before interest and tax. In either case, whether you have operating profit or operating income, you are then going to add the non-operating income and subtract the non-operating expenses, so our one-time unique costs or revenue streams. So this might be, I think we talked before in terms of you might have lawyer bills from a lawsuit, you might have expenses related to moving, you might have sold part of the organization, and so you have income coming in there. So your operating income or operating profit after those non-operating income and expenses gives you your income before taxes, or we call net profit before taxes. So you can see here that there is different terminology for the same thing. So you might see it in terms of income, or you might see it in terms of profit. So if we look at, for example, at this report from Google, what we can see here is we can see revenue of $69,685. We can see the cost of goods sold, and then we can see the overhead costs. And if you add the cost of goods sold and the overhead costs together, you'll get this line right here. Now, this particular line is labeled operating expenses. So one of the challenges in accounting, and why I am not an accountant, is that they're using lots of terminology, same terms with different meanings depending on what country you're in, where you are, whether you're in finance or accounting. And so be careful as you look at statements for your organization or for others in terms of what they actually mean. So here, this sheet is reporting Google's operating expenses as 50 grand, but that is not operating expenses as we've been talking about in terms of the overhead costs. So what they're listing here and they're calling operating expenses, which I've struck out here, this is both the cost of goods sold and the overhead combined, right? So we want to be careful about that. When you take your revenue and you subtract the operating expenses and the cost of goods sold, you'll see that gives you this operating income right here. So then you might have some non-operating income or expenses. For Google, they have non-operating expenses of $439, so we subtract that. We get our income before tax. They're paying here $3 billion in taxes. And so their income after taxes is $16 billion. Okay? So their net income is $16 billion. We can look at other organizations. So here's Amazon. It's reported the same way. So it has that same issue with operating expenses not being just overhead. But again, revenue of $116 billion. Minus the cost of goods sold, minus our overhead and operating expenses, gives us operating income of $3.7 billion. We have total non-operating income or expenses of minus $8.9 billion in expenses. So if I was investing in Amazon, I'd be like, hey, wait, what is this? Are we paying for a lot of lawsuits? Or is this simply rearranging our production process in terms of changing where we are doing things and changing locations type things? So you'll notice for Amazon, the pre-tax, the income before tax, is a negative $5.3 billion. They pay their income tax. Their income after tax is a negative $3.8 billion. So their net income is negative. And if we're looking at that in terms of the other way to report an income statement, that means their net profit after taxes is negative $3.8 billion. Once you have net income or your net profit after taxes, you can then find the profit margin. So profit margin looks at how effectively a company converts sales into net income. So we would simply take that net profit, okay, and we can look at our net profit after taxes and divide by sales. That'll give us our profit margin. If we have the income statement that's in terms of income, then it is net income divided by sales. Often what is done with the profit margin is that we add in interest and we recognize that that interest is tax deductible. This portion here allows for profit margins to be compared across companies that might have different amounts of debt. So that adjustment there allows for that comparison. So if we're looking at profit margin for our organizations, we could look at companies like Tesla. We would take our $2.3 billion net income. We are dividing that when it comes to our profit margin divided by sales. So divided by our $16.9 billion. And so the profit margin for Tesla is 13%. Let's go back and look at the other companies that we've been evaluating and see what their profit margin is, recognizing that before we were looking at gross profit margin was only based on the cost tied to a particular unit. When we start to add in all the overhead, the question is, are these companies still making profits? So let's go back to our other graphs we've been looking at. So here we have Google's net profit after taxes at $16.4 billion. If we divide that by our revenue of $68 billion, we get a profit margin that is 24%. Okay. If we look at Google, so we can see here their net profit after taxes is $16.4 billion. We divide that by our revenue of $68 billion. We get a profit margin for Google at about 24%. So 24% for Google. Oh, I just did Google twice. It's still 24%, no matter how many times you do it. 24% for Google. There was 13% for Tesla. All right, let's go find the other graphs instead of just doing the same calculation over and over again. That was Tesla. Okay, here we go. Microsoft. Microsoft has net profit after taxes of 16.7 billion. We divide that by 49.3 billion and we get a profit margin of 34%. Okay. So we can see in terms of the comparison. So we can get that profit margin whether you're looking at net profit after taxes or you are looking at net income, because remember that net profit after taxes and net income give you the same information. Okay. Before we leave the idea of profitability, I'm just going to go back to the slides I left off. Let's look at two more calculations here. There are some other profitability measures you might want to look at for your organization. One is selling cost percentage. So this looks at the cost of marketing and sales versus the revenue you make. So we would expect that advertising and sales, we have to put in more effort for sales and more promotions to sell more. So we expect advertising and sales to go up with our sales revenue. But when we look at it as a percentage, we're looking at that ratio. And so we would like the selling cost percentage to not be going up. So advertising increases with sales, but the selling cost percentage should stay about the same. Okay. We can also look at other overhead percentage. And this is all the overhead besides the selling and marketing. So this is other upper management, this is utilities, this is insurance costs. So when we look at the rest of the overhead, the rest of the costs not tied to sales and marketing or the cost of production, we would like to sell more and not have these costs go up at all, which means the other overhead percentage should go down as we sell more. We can spread out the cost of our leadership. We can spread out the cost of the insurance that we're paying, because that's a fixed amount. So the more we sell, the more we should be able to spread it across the money that we're making. So these are some other profitability measures. And let's look at one more before we end this video clip here. So the other profitability measure that we're going to look at is EBITDA. So EBITDA, earnings before interest, tax, depreciation, and amortization. So what we're looking at is the earnings. Are they increasing? So how are we generating our cash? And is the amount of cash we are generating from operations going up? So we're simply looking at new minus old divided by old, looking at are we bringing in more money? So here we have EBITDA. This is for Google. And our older numbers are here on the right. So here's 2017 and up to 2021. So notice the earnings before interest, tax, depreciation, and amortization are on the rise. So we're bringing in more cash every year we are in operations. So that's what we're looking for, is earnings growth as a way to estimate our profitability. Here's a comparison. Here's Amazon. So here's their earning before interest, tax, depreciation, and amortization. Again, lower years are on the right. So notice that the earnings are increasing, but not as quickly as for Google. So for Google, the growth was from 2019 to 2020 was about 19%, and then jumped up from 2020 to 2021 at 66%. At Amazon in 2019 to 2020, they went up 33%, and then 2020 to 21 was only 23%. Okay, so we're expecting the earnings to go up over time. So we have looked at, in terms of determining how profitable our organization is, we've looked at in the last couple videos all of these calculations here. In our next video, we're going to look at these calculations, which really relate to how we finance our operations. So they also tell us about the profitability of our organization, but they tell us from a financing perspective. So they're looking at debt and equity. And here we've been looking at, on the left, relate to our income statement and the flow of funds in terms of sales revenue versus expenses.